Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 11th, 2016. Hey, how you doing? Thank you for coming to my weekend review podcast. I appreciate it. I hope you're going to learn something valuable. Good week for the Bulls last week, so it's been pretty tough over the last month, but finally we got some good things going for the Bulls. We'll see how long they last. But like I said, thank you for coming to the podcast, and like I said, I hope it's going to be helpful for you today. And the format for today's podcast is as follows. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the confluence, what the combination of signals were that made me get into the trade. We're going to talk about how I position size based upon the current volatility of the market. We're going to talk about where I place my emergency stops, where I place my end of bar stops, how I'm going to take partial profits each day if the market goes in the direction that I would like it to, how I get to trailing stop level, and then ultimately how I am going to exit the position if I get to a major overbought or oversold level. So we'll talk about when, why, and how I am going to manage the trades going forward. Had a good week, had some good movement on the position, so I'm always grateful for that. And then after we go through the current positions, both open and close, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and then follow that plan. There's a lot of good plans out there. There's a lot of good trading approaches out there, whether you learn it from me or someone else. But the key is not getting the plan, it's following the plan. It's harder than it seems. That is what most traders struggle with for sure. So that comes down to trader psychology. It comes down to what's going on between your ears, in your brain, and sitting tight and not doing anything when you are not supposed to do anything, and taking action, and either buying or selling, entering or exiting when you need to do that. And it's harder. It's harder than people think. So I always like to teach trading psychology. It's always helpful for me, actually, and I hope it is helpful for you. After that, last night I went down through my master watch list of all the stocks and markets that I follow, and I have identified some potential markets for next week that are getting close to a confluence and some key levels. They're not there yet. If they were already there and triggered, I probably would have already taken the trade. But I always like on the weekends to go through, identify what I'm looking for the next week. So it's just done. And so the following week, I can just look at my potentials and see if they trigger. So I hope that's going to be helpful for you to see, how I kind of look out into the future and say, okay, if it gets there, that's my spot. That's my happy place if the market gets there. And if it gets there, great. I'll consider taking the trade. If it doesn't get there, then I'll just move on to another market that does. There's always something that will get to where you want it to. I promise you. Always. So anyway, let's start with the U.S. legal disclaimer, get that out of the way, and then we'll get rolling. So hang tight, please. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started on my current position. So AMD has been a great position. It's been a monster trade. I did enter this here on March 30th at 196.10. But the question is, and you can see it's done exceptionally well. It's been a really great trade. But the question is, why did I buy here? So this is a combination of an order block with a rejection of the 200-day moving average. It's an order block trade and it is a moving average trade together. But as you've heard me say many times, I like to look for the confluences, the alignments of signals happening at the same time. So this green box here is an order block, but let me take you back in time and show you how and when, or when and how these order blocks are formed. So this order block came from the past, and it started all the way back here on 11/25/25. So let me explain to you what an order block is, what I need to have in place for an order block, the way that I look at order blocks. Some people look at order blocks differently, but this is how I use them, and it works quite well. So it works for me. The first thing we need to see is we need to see what is called a swing low. A swing low is simply a low that has a higher low to the left and a higher low to the right. So that is a swing low. Higher low to the left, higher low to the right. After we have a swing low, we need a swing high. A swing high is just the opposite. A swing high is a high with the lower high to the left and a lower high to the right. Does that make sense? Swing low, followed by a swing high. The next thing we need to have is another swing low that is lower than the first swing low. Remember, this is the first swing low. First swing low, then a swing high, then here we go. This is also a swing low. It has a higher low to the left, and it has a higher low to the right. Would you agree? Okay, so we have a swing low, we have a swing high, we have another swing low, and you can see this swing low was lower than this swing low. Now, when this is in place, swing low, swing high, lower swing low, what I need to key off of is that first swing high right here. And then once we have a swing low, swing high, lower swing low, if in the future then the prices can go, excuse me, above that first swing high, as soon as that happens, now we have a market structure change, which just means that we have a swing low, swing high, lower swing low, market structure change. This changes the market structure from a bearish market structure to a bullish market structure. And as soon as that first swing high is taken out, now I know exactly where my order block is. It's the lowest closing bar prior to the market structure change. And so I take the high and the low, and that is the order block. Now I move that order block into the future. And so the idea is once you have moved, let's get a little bit more context on this. Give me a second. Okay, so swing low, swing high, lower swing low, market structure change. Once you change market structure to the upside, I want to look to buy pullbacks into the order block. And you can see we did pull back into the order block. Was it a good place to buy? Yes. Then it came back into the order block. Was it a good place to buy? Yes. And so the idea is, if this is the order block, and then for instance, you look all the way up here, or you look all the way up here, can you look back at this area and say smart money was buying here? And the answer is 100% yes. When the price is up here and the order block was down here, I think it's safe to say smart money was buying here. So now that we know that this is the smart money area, I am waiting for pullbacks back into the smart money area. And there's different ways to enter when you get into the order block, many different ways, but I'll show you. But the idea is this was smart money. If it comes back into smart money, will it be smart money again? Not necessarily. Things can change, but more times than not, it is smart money. And even right here, I mean, I can show you two examples, right? We have a swing low, we have a swing high, we have a lower swing low. We change market structure to the upside, so I want to buy dips back into the order block. Anything in the order block, good place to buy, 100%. Came back into the order block. Good place to buy, 100%. As a matter of fact, I took this trade. Now that I think about it, I took this trade right here, and it was a nice trade. Okay, so we bring this order block into the future, and now I am just waiting for the price to get back to a level inside the order block that I'm interested in. So again, the order block formed in the past, I bring it into the future. And like I said, there are many different ways that you can enter an order block. You can enter an order block with the rejection of the bottom of the order block, meaning, here's an example, you close below and then you close back in. Well, that's a rejection of the bottom of the order block. That would have been completely legitimate. But so you can get in with the rejection of the high of the order block, you can get in rejection with the low of the order block, but really my favorite thing to do is get into when you have a rejection of a major moving average, like a 200-day moving average, a 250-day moving average, a 300-day moving average that lives inside of the order block. And so that is why I took the trade here on the 30th of March, because we have a key level within a key level. We have a 200-day moving average, which just by itself is a key level, but that key level of the 200 lives inside the order block. So the reason I took the trade here on the 30th was during the day, the price went below the 200-day moving average, but at the end of the day, it closed above. And by the way, I always make all my buying and selling decisions based upon the closing price. I'm looking for a rejection of a bottom of the order block, for instance, or a rejection of a 30 RSI and then a close above the 30 RSI at the end of the day. Well, same with this trade. During the day, we went below the 200-day moving average and then we closed above the 200-day moving average. Okay, so that is why I took my trade. 200-day moving average inside an order block, key area within a key area. Okay, so now that I have my trade, intraday rejection of the 200-day moving average, and I say, okay, I'm going to take this trade. What I need to decide now is obviously how many shares am I going to buy? And I tell my students this all the time, but listen, that's the most important decision you're going to make in a trade is how many shares you're going to buy. If you don't buy enough shares, it's not going to be worthwhile. If you buy too many shares, it could be devastating if you're wrong, even with the best starting setup. So I'll share with you the formula that I use. It served me well over many, many years. I've been trading over 30 years, and I have used this formula for a long time. So let me just share it with you. So there's two inputs. The first is how much money do I have in my trading account? Let's just say I have $100,000 in my trading account. What I do is I simply take 1% of the 100,000, which is 1,000. If it was 200,000, it would be 2,000. If it was a million, it would be 10,000, right? So 50,500. So 1% of your total trading account, 100,000 times 1% is $1,000. And then I look up here for the value of the 2 ATR. An ATR is an average true range, or in other words, how much is this particular market expected to move in any one day? I take that number, times it by 2, and that gives me the 1982. And so this number is the volatility. When volatility is higher, this number is going to be higher. And what I do is I take the $1,000 divided by the 1982. And so based upon how much money I have in my trading account and on what the volatility is, this number, the average true, the two ATR, tells me to buy 50 shares. Now, if this number was lower, if volatility was lower, then this number would be lower. And dividing it into 1,000, this number would be higher. It would tell me to buy more shares. But when volatility is very high, this number's larger, and therefore dividing it into my maximum allowed loss, it's going to give me a smaller number. Just makes sense. Volatility is higher, you buy fewer shares. Volatility is lower, you can buy more shares. Make sense? Okay, so that is how I decide how many shares. So again, let's go back. Why did I enter the trade? I entered the trade because it rejected the 200-day moving average inside an order block. Okay, I decide I'm going to take the trade. I just did the math. I'm going to buy 50 shares. Now, the first thing that I do is I take my entry price. As soon as I enter, I take my entry price minus the value of the 2 ATR, 1982, and I place my emergency stop down here. So if I have 50 shares and it moves $19.82, how much have I lost? Well, we just did the math. It's roughly $1,000, right? So that is my maximum allowed loss on this trade. And That's something I have to decide and say, okay, am I okay with this $1,000 loss if I'm wrong? I have to be okay with it. But the good news is the emergency stop, when you lose 1% of your account, this only happens about 5% of the time. 95% of the time, if I have a losing trade, it is not because it hit my emergency stop. It is going to be because it hit my end of bar stop. I always use two stops: emergency stop, worst case scenario, end of bar stop. And my end of bar stop is generally a reversal of why I took the trade. Why did I take this trade? I took this trade because it rejected the 200-day moving average. Therefore, going in the future, if the very next day it had closed below the 200-day moving average, even a penny, I simply would have gotten out for a very small loss. So remember, two stops: emergency stop. If it gets there, I'm going to lose 1% of my account, but that only happens about 5% of the time. The other 95% of the time, if I have a stop, it will be because my end of bar stop triggered. And because it rejected the 200-day moving average, the next day, if it closed below, I would have gotten out of the trade. Okay? All right. I hope you're with me so far. But really, this, you can see, with this closing above the 200-day moving average, it gives me a very, very good risk to reward. I have my stop below me as support. And if the next day it closes below just a little, I'm out, right? So it's nice. It's very important in trading that, one, you're patient and wait for your trade. And two, you have a good starting initial risk to reward ratio. So if you're wrong, you can be wrong, very small. But if you're right, like on this trade, you can have a large outsized gain starting with just risking, hypothetically risking a little bit of money. And that's what trading is all about. Okay, so we have the order block from the past. We reject the 200-day moving average. Perfect. I got in 196.10. I position sized. I placed my emergency stop 2 ATRs below, end of bar stop, close below the 200-day moving average. Now, as soon as I have that in place, the next thing I do is I need to refer back up here to the 1.5 ATR. And right now on this particular day, the 1.5 ATR is 1487. So as soon as I enter and I have my emergency stop, end of bar stop, then whatever the value of the 1.5 is on the day that I enter, I take my entry price plus whatever that value is to the top. Okay. Entry price, I look at the 1.5 value, I add that value to my entry price, and I place the trailing stop level above. Now, in trading in general, if you enter a trade and it starts to move your way by a certain amount, then you want to start tightening up your stops. So that if because it's moved nicely your way, you don't want to give it all back. And so this is the way that I do it. When I enter, I place my 1.5 ATR trailing stop level above. If I'm fortunate enough to have the market move my way and it gets to the trailing stop level, it touches that trailing stop level, that's my threshold to tell me now I'm in trailing stop mode. Trailing stop mode doesn't mean I do anything or take any action. It just means that I am in trailing stop mode. And being in trailing stop mode just means now that I'm in trailing stop mode, in the future, if I have a close below a previous bar's low, I'm going to exit half of my position as a precaution. And by exiting half of your position, it has the effect of moving all your stops up by half because you're selling half. You're not actually moving the stops up. The stops are staying in place, but because you've reduced your position size, it has that same effect. So yeah, once your position starts to move in a certain way, you do want to tighten things up, and going into trailing stop mode and then selling half if you have a close below previous bar's low has that effect. And so that's why I do it. And I'll show you many examples today of why that was a smart move. All right. All right. So everything I've talked about so far, as far as your emergency stop, your end of bar stop, going into trailing stop mode, these are all defensive moves. In other words, if the market moves against me, I have to take action defensively. But just like with any good sports team, you can have a great defense But you also need to play offense. And I just, in trading, yes, I play a lot of defense with the emergency stop, the end of bar stop, going into trailing stop mode defensively, but I also want to play offense. And I play offense by selling a certain amount of my position every day if it moves a certain amount from the previous day's close. So I am currently in AMD. And let me just show you and explain how I'm going to set this up for Monday. It's very simple. All I do is I look at the closing price of the day. Right now it is 244.90. So I just take 244.90. And now I look for the value of the 0.45 ATR. The 0.45 ATR value is 446. I just add them together. The closing price plus the value of the 0.45, 244.90 plus 446. This is my first profit target for Monday, 249.36. So let's put it up here, 249.36. That's my first profit target for Monday. Okay. The question is, how much am I going to sell there? It's very easy. 10% of however many shares I go into the day with. If I go into the day with 50 shares, I'll put a limit order in my trading platform that says sell 5 shares at 249.36, right? Take advantage of the up move and sell into that. Now, I don't just place one profit target. I place 3 every day. So the first profit target is the closing price plus the value of the 0.45 ATR. That is 249.36. To get the second profit target, I take the first profit target, 249.36, and I just add the value of the 0.45 to it again, plus 4.46. My second profit target for Monday's 253.82. 253.82. And then I do it one more time. I simply take my second profit target, 253.82, and I add the 0.45 to it again one more time, plus 446. My third profit target for Monday is 258.28. 258.28. There you go. There are my 3 profit targets for Monday. And again, 10% at each level. If I go into the shares, if I go into the day with 50 shares, I sell 5 here, sell 5 here, sell 5 here. Now, if the market on that particular day goes up decently, you'll probably hit one profit target. Great. You lock in some money. The market, after that, the market can't take it away from you. You reduce your position size a little bit, which in my opinion is huge, because the lower and lower your position size gets, the easier it is for you to stick with your process. And like I said, I'll show you many examples today of, thank goodness that I took those partial profits. And the other thing is, if, I've had days where I've hit 2 profit targets, 3 profit targets while it was strong in the morning, and then it reversed, and I'm sure glad I did it, right? So, okay, so we've talked about the entry, the rejection of the 200-day moving average inside the order block. We talked about position sizing based upon the volatility of the market. We've talked about where to place the emergency stop. We've talked about where our end bar stop is. We've talked about going into trailing stop mode, and we have talked about selling into strength offensively if the market goes our way. And by the way, if AMD comes down on Monday, I don't hit any profit targets, and then I have to redo my profit targets for the next day based upon the most recent day's close, right? So, all right. So I think we've covered the basics, and let's just go through the trade. All right. Took the trade here on the 30th of March at 196.10. Why? Rejection of the 200-day moving average that lives inside the order block. We position size, place our emergency stop 2 ATRs below, end of our stop, simply a close below the 200. I'm so close to the 200 anyway that if it closes even a penny below, I'm out. But the key is that it rejected it. There were no more sellers under the 200, at least for that day, and I have the 200 underneath me as support. I placed my 1.5 ATR trailing stop level, 1.5 ATRs above, and here we go. Let's start the trade. Next day, great. Moved up in my direction. Perfect, hit a profit target, not at trailing stop yet, but hit a profit target, took a little off, locked it in the bank. Next day, up nicely again. So I hit multiple profit targets on the second day up. In addition to that, I did get to trailing stop level. Doesn't mean I do anything. It just means now in the future, if I have a close below any previous bar's low, I'm going to get out of the trade. The next day started off really ugly, but closed strong. And so I hit another profit target on that day. Remember, I'm still in trailing stop mode. Next day, up again, hit more profit targets. Next day, up a little, but not enough for a profit target. Next day, up nicely, multiple profit targets. Remember, we're still in trailing stop mode, right? We haven't had a close below previous bar's low. Next day, up a little profit target. And then on Friday, up huge. Again, multiple profit targets. So we're in trailing stop mode, but we have not had a close below previous bar's low. Great. Now, this particular trade just moves up so fast that we haven't even had a close below a previous bar's low. There are certain areas where I'm looking to exit the trade that are overbought levels. And this right here, the 70 RSI right now is, I'm sorry, the RSI right now is 70.09. Whenever I start to get to the 65 RSI, now I have other rules kick in. If I get to a 65 RSI and then I close below the 5 EMA, that's the end of the trade. But one of the other major signals that I have is if we reject the 70 RSI, I'm again going to sell half of however many shares that I have. Right now it's 70.09, so it did not reject the 70 RSI. It's above it. Monday, if it closes below the 70, I'm out of half of the position. Monday, if it closes below the 5 EMA, I'm completely out of the trade. If it continues to keep moving up, perfect. I will continue to sell offensively into this trade. But just to make it easy, this trade's very easy at this point. It's 70.09. If Monday it closes below 70, I'm going to sell half. After that happens, if I have another close below previous bar's low, I'm going to get out of the entire position. I know if you're new to this, maybe this sounds complicated, but it's really not. So again, I just placed the profit targets for Monday. We'll see what happens. But just basically, if anytime in the future now we close below 5 EMA, I'm out of the trade. If anytime in the future we close below the 70 RSI, I'm out of half of the trade. So this particular trade is a very good example of being patient, waiting for a rejection of a key level within a key level, having a good risk to reward ratio, and you never know what's going to happen. But this trade from the remaining shares that I have up 19.77%, which is just fantastic trade in a couple weeks. All right, let's go to silver. All right, so the majority of the trades that I use, I do exactly what I just explained to you. I take partial profits, I go into trailing stop modes. I do that all except this particular strategy. And so I entered silver back here on the 18th of February at 69.80. So this is a combination, this is a confluence of signals happening at the same time. You can see here's the order block from the past, right? We had a swing low, we had a swing high, we had a lower swing low, and then we changed market structure to the upside, and that defined that order block. So on the particular day that I took the trade, this is what is called a rejection of the high of the order block. You can see the previous day was in the order block, and then it closed back above the order block. That is a rejection of the order block. Remember, you can have a rejection at the bottom of the order block, you can have a rejection of the top of the order block, you can have a rejection of a key level within an order block. So this was a rejection of the high of the order block. Now, normally I would not have taken this trade, but the reason that I did take the trade was you can see the bar prior, you can see I highlighted in blue. This is what is called an abandoned baby. An abandoned baby it happens when you have a gap down from the close to the open, you had a gap down, but then the very next day, right after having a gap down, you had a gap up. So this is a very sudden shift in sentiment from bearish to bullish. When this happens, in my experience, when you have a very sudden shift in sentiment, bearish to bullish, more times than not, when you look out into the future, you are going to have higher prices. Not all the time, but more times than not. So that's something important for me to know. So I had a nice confluence of a signal. I had a close under, close over the order block, which by itself is legit. But in addition to that, the confluence was I had this abandoned baby. Gap down, gap up. Now, when I take these trades, these abandoned baby trades, I don't go into trailing stop mode. I don't take partial profits. These are so strong, in my opinion, that I want to diversify a little bit from the way that I manage these trades. So I make this very simple. I entered here at 69.80. I take my maximum allowed loss divided by the 2 ATR, and I have my emergency stop. Remember, if I hit my emergency stop, I lose 1% of my account. So I have a 2 ATR stop below me, but I also place a 4 ATR profit target above me. So I'm risking 1% to make 2%, which is fine. That's asymmetrical risk to reward. That's good. If I'm right, I'm going to make more than if I'm wrong. And I know with these abandoned babies that more times than not, they're higher. So that's a good setup for me. That's a good structure I'm risking 1% to make 2%, but the chances of me making 2% are higher than me losing 1%. Make sense? So this is just kind of a set it and forget it trade. So rejection of the high of the order block plus the abandoned baby, I got into 69.80, put a 2 ATR stop below me, 4 ATR profit target above me. One of two things is going to happen. I'm going to lose 1% or I'm going to make 2%. And one of those two things will happen for sure, because eventually we'll get down here to my 1% or we'll get up here where I make 2%. So the trade started off very nicely, moved up, moved up, moved up, then down, and then it got really bad. Never got to my stop though. And now we have been moving up a little bit. So this trade was down quite a bit. It is still currently down, not too much, but at the moment, this trade is down 0.83%. But again, going forward, one of two things is going to happen. I'm going to lose 1% of my account or I'm going to make 2% of my account. Hopefully it's the latter, but we'll see. But currently this trade is down 0.83%. All right, Microsoft. Microsoft's interesting trade here. I entered Microsoft here on the 2nd of April. Kind of an interesting setup. To begin with, we had a rejection of the high of the order block, right? The green is the order block. The previous day we were in the order block and then we closed above it. Okay, by itself, legit. I usually wouldn't take that trade in this context, but it's something. Rejection of the high of the order block. But the reason that I took it was because on this day that I took it on the 2nd of April, we have what is called a higher low V1. A V1 consists of two bars, bar 1, bar 2. The requirements for this is bar 2 has to go below bar 1's low, which it did, and then bar 2 has to close above bar 1's close, which it did. So I would not have taken this trade individually with either of these, with this high or low. I would not have taken it with the rejection of the high of the order block. I would not have taken it, but in conjunction, I did take the trade. So I took the trade here on the 2nd at, come on now, what's that price? 373.44. I position size. I placed my emergency stop, of course, 2 ATRs below. Now, when you have a higher low V1 or a V2, this is a V1, the stop on this is halfway of the washout bar. Bar 1, bar 2. Bar 2 is always the washout bar. We call it the washout bar because it washed out. It went below bar 1's low. So whenever I have a V1 or a V2, my end of bar stop is a close below halfway of this bar. And that's why I drew the line there, 369.16. All right. So again, why did I enter? Higher low V1 in addition to rejection of the high of the order block. I got in 370, 344. I position size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop, a close below halfway of the washout bar, 369.16. And you can see my entry price to where my end of bar stop is pretty close, right? I always want to have them pretty close because so I have a good risk to reward. I also placed my trailing stop level 1.5 ATRs above, and here we go. Next day, didn't do much. No profit targets, no nothing. The next day did go below my end of bar stop during the day, but of course I wait until the end of the day to get in, and it closed back above. Kept me in the trade. The next morning we had that big, huge up move where thankfully I sold multiple profit targets into that strength, right? That's the advantage of taking these partial profits. We had a big gap up. I sold multiple profit targets into that strength. In addition, I touched trailing stop mode. So now I'm in trailing stop mode. Remember, I don't do anything. It's just that now I'm looking for a close below previous bar's close to get out of half. Well, the next day, during the day, we went below the low, but we closed above the low. That kept me in the trade. And then on Friday, yesterday was down, but we did not close below previous bar's low, and we did not close below my end a bar stop of 369.16. So this particular trade at the moment is down. It's down 0.71%, but it is still holding my stop, so I'm still in the trade. I'm still bullish. And by the way, if you want to learn more about V1s or V2s, like I use them all the time in my trading, they're a great thing to know about. Just go to my YouTube channel. I have a video there on V1s, V2s. So go check it out, and it's good because I get into all the details. So that's on my YouTube channel. So anyway, this particular trade currently is down 0.71%, but still holding, and I am in trailing stop mode, and it is still holding my stop, so I'm still in the trade. XLV. All right. XLV. Nice combination of a deep dip buy rejection of a major moving average, which is the 200-day moving average inside an order block. So this blue box here is a more recent order blocks, and order blocks can change. They can go higher, they can go lower, but let's look. Why was this new? This green was an order block from the past, but now this new blue order block was formed, and let's take a look why. Well, here you have a swing low, here you have a swing high, here you have another swing low that's lower than the first swing low, and then this bar here went above the swing high, changing market structure to the upside. As soon as that happened, the lowest closing bar before the market structure change became the new order block. The high and the low of this big down bar was the order block. That's the blue. That's why I moved it into the future. So I didn't buy the breakout. I'm waiting for a pullback, and I entered here on the 6th at 146.31. Why? Combination. Rejection of the high of the order block. You can see during the day we went into the order block, closed back above it. That's rejection of the high of the order block. And we also rejected the 200-day moving average, key level within key level. So I position sized. I entered 146.31. I placed my emergency stop, of course, 2 ATRs below. Where's my end of bar stop on this trade? Simply a close below the 200. I entered very close to the 200, so that's what I want to use as my stop. The next day, it gapped open. I hit a profit target. Then it sold off, went below my stop, but I remember I wait until the end of the day to make my decisions. The end of the day, it rallied, closed back above, kept me in the trade. The next day, huge move up where I hit multiple profit targets into that strength. I think I hit 3. And I also got to trailing stop mode. Remember, I don't do anything. I'm just in trailing stop mode. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. The next day, nothing, but it didn't close below the previous bar's low, so I don't do anything. And then what happened on Friday? Friday was the first close below a previous bar's low after reaching trailing stop level. So what did I do? I took off half of the remaining shares that I had and locked in a gain of 0.68%. Now, I still have half my position. I only sold half, and selling half is one of the best things you can do in trading. It's one of the only win-win situations. If Monday this comes down, way down, am I glad that I took off half here at a positive level, profitable level? Yeah, of course. Conversely, if it goes screaming up on Monday, am I still glad? I should be, because I still have half the shares. So that's one of the advantages of selling half. So good example of a combination of rejection of the 200-day moving average and the rejection of the order block, having a good starting risk to reward, staying in the trade, taking advantage of a big move up, selling into that strength, going into trailing stop mode, and then because we are in trailing stop mode, having our first close below previous bar's low after reaching trailing stop level, selling half. And again, this just has the effect of moving all these stops up by half because we sold half the position. So the remaining shares that I have on XLV up 0.68%. Alibaba. Alibaba's been a very, very good trade and a good example, teaching example here. So I got into the trade on Alibaba at 120.10. If you've been watching the podcast for a while, I have been looking for this level for weeks. I've highlighted Alibaba. I said, look, here's an order block below. I'm not interested here, but I'm interested in if we reject the high of the order block, if we reject the low of the order block, or if we reject possibly a 30 RSI inside the order block. And that's exactly what happened on the day that I took the trade. RSI doesn't have lines. You don't see them, but you have to look for the RSI level over here. On this particular day, during the day, we went under the 30 RSI, but by the end of the day, we closed above the 30 RSI. That's a deep dip buy entry. When I talk about deep dip buy entries, I'm talking about a rejection of the 300-day moving average, the 250-day moving average, or the 200-day moving average, as well as a rejection of the 30 RSI. And on this day, we rejected the 30 RSI. We went under the 30 RSI during the day, closed back above the 30 RSI. That by itself is a legitimate entry. Now, would I have taken that just by itself? It's unlikely. It's possible. It depends. But I did take the trade for sure because the under 30 during the day and then the close back above the 30 at the end of the day also coincided with what? A rejection of the high of the order block. You can see during the day we were below it and then we closed back above it. So I entered here on 4/7/26 at 120.10. I position size based upon the volatility. I placed my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below the 30 RSI. If I take you back to the day that I entered, where did it close at? It closed at 31.90 on the RSI. So the next day, if it closed below 30, if it closed at 29.99, I simply would have gotten out. So a close below 30 RSI is my end of bar stop, okay, which I was very close to begin with, so a good starting risk to reward. Okay, so after I entered 120.10, I placed my trailing stop level 1.5 ATRs above, as always. Next day, right out of the gate, it gapped way up. I hit multiple profit targets, which is perfect, right? I hit 3, possibly 4, but I think it was 3. And I'm also in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I get out of half. The next day, open lower, went up. I hit a profit target there, which was great. And then on Friday, hit one profit target near the high before it reversed. So I am in trailing stop mode, but I haven't had a close below previous bar's low. This particular trade at the moment, remaining shares up 5.72%. And again, combination of a rejection of the order block and a deep dip buy entry. So up, remaining shares up 5.72. Okay, McDonald's. This is interesting. because I got in and out, I got in McDonald's, got out of McDonald's, and then got in McDonald's again. And so let's talk about the entry that I took on McDonald's on Friday. Here's your green box. This is the order block from the past. Here's your 200-day moving average, the black line. Here's your 300-day moving average, the orange line. So the new trade that I took on Friday, I entered here at 305.69. Why? Rejection of the 300-day moving average inside the green order block, key level within a key level. So I entered 305.69. I position size. My emergency stop is down here, 2 ATRs as always. My end of bar stop on this trade will simply be a close below the 300-day moving average. Now, it's extended a little bit above the 300. I'd like to get them when they're right there. It's a little extended, but not that much. Like, I can live with this. So again, I have my 2 ATR emergency stop below. If I get there, I lose 1% on my account. And my end of bar stop going forward on this trade will just simply be a close below the 300-day moving average. Place my 1.5 ATR trailing stop level above. And if we start moving up, of course, I will start to sell partial profits if it moves the value of 0.45 ATRs from the previous bar's close. So if it continues to move up, great. I'll take partial profits into that. If I get to trailing stop mode, I'll get into trailing stop mode, which is great. If it Monday closes below the 300-day moving average, that's my end bar stop, I'm simply out of the trade. If it has a horrible day on Monday and goes all the way down and hits my emergency stop, of course, I'll get out then too. By the way, with emergency stops, my entries and exits are based upon the closing price, but the emergency stop, there is no closing price rule. If it ever gets there at any point during the day, whether that's 1 second after the market opens or 1 second before the market closes or anywhere in between, doesn't matter. I get out. If I say 1% is my maximum allowed loss, I don't hang around until the end of the day. If it gets there, it gets there. I said I can lose 1%, and if I lose 1%, I got to get out then and right away then. Okay. But if that happens, great. Okay, I'm out 1%. But the majority of the time, again, if I have a loss, it's going to be because I have a close below this 300-day moving average going forward. So I just entered the trade on Friday, completely break even on the trade. All right, so those are the open positions. AMD remaining shares up 19.77%. Silver remaining shares down 0.83%. Microsoft remaining shares down 0.71%. XLV remaining shares up 0.68%. Alibaba remaining shares up 5.72%, and McDonald's break even. So, in trading, the acceptable outcomes are obviously one, a big loss. You could have a small gain. I'm sorry, a big gain. Ideally, having big gains is great. Having small gains is great. Having break-even trades is great. Having small losses is great. All acceptable. The only thing you really want to stay away from are big losses. And if you position size correctly and start with a good risk to reward ratio, the chances of you having a big loss are small. And so just going over the numbers that I just showed you, I've had some big gains like on AMD and Alibaba. I've had some small losses on Silver and Microsoft. So you can see I'm trying to practice what I preach by big gains, small gains, break even, small losses, fine. And that's with the positions that I currently have. It's about what it is. No big losses. Now, let's go to the positions that I closed out on Friday. All right. Now, this was kind of a bummer, kind of unfortunate on Palantir, but it is a good teaching moment to show you why taking partial profits when you have them is such a good idea. So I've been in Palantir for a long time. I got into Palantir back here on the 5th of February at 129.62. Why? What was the confluence of signals? One, we rejected the bottom of this order block during the day we went below the order block and then we closed above it. I got in 129.62. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block, below the green box. I placed my 1.5 ATR trailing stop level above, and here we go. The next day went up. Great. Sold profits into that, which you'll see now was super important. Next day, again, big day up. Sold into that strength, also got your trailing stop mode. Next day down. Next day was our first close below a previous bar's low. After reaching trailing stop level, what did I do? I sold half for a gain of 4.64%. Next day down, but it closed above the bottom of the order block, kept me in. Next day, we opened up below, but closed above, kept me in. Next day, closed above. Next day, up, where I took advantage of that move up to sell into strength. Then we moved back down. We again tested the order block on this day here. I thought for sure I was going to get stopped out of the trade, but I did not because it closed back in it. And then we went on this 10-day run where took profit targets. Took profit targets, took profit targets, took profit targets, right? Took advantage of that strength. And then we kind of moved sideways. Every once in a while, we'd have a big up day where I took some profits. Then we headed back down, up again, took profits. Here, 3 days ago, gapped open big. Thankfully, took profits into that. But now look what happened. On Friday, it finally closed below the low of the order block. The remaining shares I had to get out of for a loss of 1.29%. Okay, that's fine. But overall, was I profitable on the trade? Yeah, 100%, because I sold into strength. I took half here. I sold into strength. I sold into strength. I sold into strength. I sold into strength. So yeah, all in all, I definitely was profitable on this trade. But it finally closed below the low of the order block. But can you see in hindsight how important it was that I took advantage of some strength while I had it, right? So all in all, the remaining shares loss of 1.29% for sure, but still very profitable on the trade because I have the process of going into trailing stop mode, taking half, selling into strength. The remaining shares down to 1.29%. CPB. All right, I took this trade on Thursday. Was not a positive trade, but it's a good example of being very patient with your winners and being very impatient with your losers. And that's in my opinion, that's the correct way to be with a position. If you're right, stay in the trade. If you're wrong, get out quickly. And so I got into the trade here on the 9th of April at 2079. This is CPB. This is Campbell Soup. Why did I get into this trade? Well, it was a confluence of two things. It was a confluence of a V1. We talked a little bit about V1s. V1s are two bars, bar one, bar two. Bar two goes under bar one's low. Bar three closes above bar one's close. That's a V1. In addition to that, during the day, on this day, we were below the 30 RSI and closed back above the 30 RSI. So that was a confluence. Intraday rejection of the 30 RSI in addition to a V1. So I entered here at 2079. Now, I took the trade because of the V1 and the rejection of the 30 RSI, because this day it closed above 30 RSI. But look what happened on Friday. It closed back below 30 RSI, 28.74. So was my end of bar stop. I got out of the trade. So this was a one-day trade. I was in, I was wrong, I got out. Did I lose money? 100% I lost money. But 1.81%, not fun, but I'm not going to stick around. I can always get back in, right? If it closes back above the 30 RSI on Monday, I can always take another shot at it. But we were above 30, which was strong. We closed below 30, which was weak. And if this heads back down the rest of the week, I'll be really glad that I took my stop. And if it rallies and closes above 30, I can consider getting into the trade again. So this was a loss of because it closed back below the 30 RSI of 1.81%. Apple. All right, so this is an interesting trade. So I got into Apple here on the 31st of March because we had a close under the 200-day moving average and then a close back over the 200-day moving average, and it happened inside an order block, which is great. But on the day that it closed back above the 200-day moving average, see how far it closed above the 200-day moving average? This 200-day moving average would be my end of bar stop, and it was really far below me. So I didn't really want to get in because the risk to reward was not good. But on the other hand, I realized that this was a very strong reversal. So I was at a big of a dilemma of I want to be an Apple, but it's not a good risk to reward ratio. So how can I express the trade? So on something like this, what I did was I sold puts. Selling puts is a bullish position. Now, when you sell puts, you get premium. And it's a defined amount of premium. You can't make any more than the premium you got. So what I did on this particular day, on the 31st, I sold puts down here to 247.50. Why did I sell them there? Well, because it was under the 200-day moving average. So I got in, sold puts down here to 247.50. Now, they expired on Friday. So if I sell a put down to here and then the expiration day comes and it is anywhere above that price, I make the premium, I pocket the premium, the contract is finished. And so that's exactly what I did. I sold puts down to 347.50 for how many days was that? That was, I was in the trade 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7 days. Exactly 7 days. And this paid over 2% premium. Doesn't matter if it went up 100 points or it just closed 1 penny above that 247, I would still make above 2% for the week, which is pretty good premium. Now, I also have, even if I sell puts, I still have my stops. I still have my 2 ATR stop below me, and I have my end of bar stop, which is the 200-day moving average. So on this particular day, when Apple was way down and it was under the 200, had it closed under the 200, I simply would have gotten out of the trade. But selling premium on options, you have the time decay, which when you're selling those premiums, you get that premium every day. So even if it just moves sideways, I would make money every day. So here, every single day that goes by, it's burning premium and it's burning theta. So the long and short of it is, again, I didn't take it the regular swing trade because the risk to reward wasn't good, but I thought it was a good time to express the trade in Apple. I didn't know how much more it was going to go up, but I didn't think it was going to go down that much. So that's why I sold puts and I exited the trade on Friday and made over 2% premium for the week. And yeah, this is the first time I've actually highlighted options that I have sold. But I do a lot of options trading, actually. Really, I involve options in a lot of things that I do. Never buying options, but always selling options, either selling calls or selling puts. And I'm a big fan of selling premium. But this was a good example of why I did it and made over 2% for the week by doing this. But that expired on Friday. I'm out of the trade. Okay, so that's it. On the closing trades, the remaining shares on PLTR lost 1.29%. CPB, Campbell Soup, lost 1.81%. And then on the Apple, the premium was over 2% for the week positive. All right. Now, last one is on the weekly charts of UUP. UUP is the US dollar. And I have been in this trade for a long time. I finally got out on Friday, but let me take you back all the way back. Again, everybody, these are weekly bars. Weekly bars close on Friday. So when the bar closes is when I make my decision. So I got into the trade on 7/11/25. I've been in this trade since July of last year. I got in 26/31. Why? Two confluences. The first one was we closed under the 200-week moving average, and then we closed over the 200-week moving average. That was one. But in addition, we also rejected the high of the order block. You can see on this bar, 7-4, we were inside the order block, and then the next week closed above it. Okay, they're both legitimate signals: rejection of the high of the order block and a rejection of the 200-week moving average by a close under, close over it. So I got in here 26/31. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 200-week moving average. Soon as I entered and I knew my emergency stop and my end of bar stop, I placed my 1.5 ATR trailing stop level above, and here we go. Trade started. Next week, by the end of the week, perfect. Up, hit a profit target. Next week, down. Next week, huge move up where I hit multiple profit targets into the strength, took multiple profit targets into the strength, and I'm also in trailing stop mode. Next week, down. Next week, down. It's our first close below a previous bar's low after reaching trailing stop level. What did I have to do? I had to sell half. I sold half for 0.49%. Then we moved sideways for about a month, didn't do anything. And then this week here, we were well below the 200. And I thought, well, I've got to get out of this for sure. But by some miracle, it ended up at the end of the week closing above the 200, which kept me in the trade. Next week, up again, took profits into that strength. Next week, really nothing. Next week, up again, took profits into that strength. Couple weeks, nothing. Next week, up again, took advantage by selling profits into that strength here. And then we came down for a couple weeks, and then we had another nice up move where I took profits. Then we came down for about a month and a half. Then we had a couple week rally where on this particular week took profits. Then we headed down strongly. And again, on this week, we were well below the 200-day moving average. And I thought for sure I'm going to get out this. But again, it rallied by the end of the week, closed above the 200, kept me in the trade. Next week was up, profit target. Next week came back down, retested the 200, closed above, kept me in the trade. Next week up nicely, profit target. Next week nothing. Next week up really nicely, more profits into that. Next week really strong again, took profits into that. So for the last few weeks, we have been above the 65 RSI level. And when we get to 65, I'm thinking two things. I'm thinking if it goes higher and rejects the 70, that's where I take profits or potentially get out of the trade. Or if I get to 65 and it closes below the 5 EMA, which is this thin blue line, if it closes below, that's the termination of the trade. And finally, on Friday, we had our first close below the 5 EMA after being at 65 RSI level or higher. So what did I do? I finally exited this trade, which I'm kind of glad because I'm kind of tired of talking about it for 6 months. So I did end up closing the trade for a gain, the remaining shares for a gain of 4.12%. So it was a really good trade. And that is it as far as the current positions and the closed positions. Those are all my trades for this week. So it was a good week. Very grateful for that. And before we start looking at the trades for next week, let's spend a few minutes and talk about trader psychology, all right? I think it's important. Hopefully it will be helpful. Okay, this week's trading psychology post is from Paul Rotter. I really like this post. I think it's really important. A lot of people fall into this. And let's read it. As a trader, you should have no opinion. The more opinion you have, the harder it is to get out of a losing position. And this is so true. You know, I speak with a lot of traders from around the world every single day, and I get a sense of their opinions, what they're talking about. And I know people, even last week, that they had an opinion of something that was going to happen in the world, so they didn't take a trade. Well, it cost them, right? And then I have opinion of other people who think a stock's going up, but there was no signal, but they stay in the trade because their opinion is it's going to go up. And in both cases, they were wrong. If I could give you my best advice is listen to the charts. I don't care what your opinion is of the world, of the politics. If the chart tells you something, to me, that's the only truth, is the truth of the chart. It's not what you read. It's not what you watch on TV. It's what the chart is telling you. So personally, I don't care what's going on in the world. If my charts tell me to take a trade, even if things look dire, I take the trade. If I'm really bullish on a stock, but it is there's no signals, I just don't get in because the market is telling me, and the collective market always knows best. So as a trader, you should have no opinion. The more opinion you have, the harder it is to get out of a losing position. And I could flip that around too. The more opinion you have, maybe you're bearish on a stock, you're in a trade, but it keeps going up, but you get out because you're bearish on the stock, but it keeps going up, right? So the more opinion you have, the harder it is to get out of a losing position, and the more likely it is you get out of a positive position because you're bearish on it while it keeps going up. So that's my best advice, everybody. I know it's hard. You're human. We have opinions, but professional traders listen to their charts, listen to their signals. And in the long run, I think you're going to have a much easier time of trading and you're going to be more profitable. So thank you, Paul Rotter, for that. Appreciate that. And now let's take a look at some of the trades for next week. I don't have a lot of them, but the ones that I have look pretty good. So I'll share these with you. You can see I have 6 different potentials for next week. Now, I mention this every single week. Listen, here's 6. Monday, potentially all 6 of these could trigger. Does that mean I'm going to enter all 6? No. I don't care if I have 100 signals that trigger. I have to narrow it down to the best signal. And how do I do that? I give a score to each setup. If I have 5 that are legitimate, there's going to be one that's going to be out of that 5 that's going to be the best. And I look at how many entry signals do they have. Obviously, if one stock has 1 entry signal and the other stock has 2 entry signals, I'm more likely to take the one that has 2. But you have to counterbalance that with the risk to reward. Maybe you have one that has 5 entry signals, but the risk to reward's not very good. Well, you have to take some points off for that, right? I also look at higher time frames. If I'm trading the daily time frames, I want to look to the weekly time frames to see if I can get some confirmation of maybe a signal on the weekly time frame as well. That gets extra bonus points. I also look at relative strength. If the entire market is down, but one stock is up, I'm going to more heavily weight that stock that is up because it was up on a down day. So it gets extra bonus points. All right. So this is how I look at trading. I give everything a score. And with these 6 symbols, if they all trigger on Monday, I will find the one that is better than the rest. And this is what I teach. This is how I trade, and this is what I teach my students. And if I could just put in a quick little plug, I do teach students all over the world. I have done so for many, many years. I have taught students from absolute beginners all the way up to the hedge fund level and everywhere in between. I love to teach, and I teach a really good course. I teach a 20-hour one-on-one course, and we study together 2 hours a week for 10 weeks. That's where you get your 20 total hours. I teach you all of my setups. I teach you every single rule. We practice them. We go through, we do a lot of simulation trading, and I'll teach you everything I know, everything that I use in my experience of over 30 years as a trader. And I think the best way to learn anything is one-on-one, whether it's trading or golf, tennis, baseball, whatever. And that's how I learned all my trading, was hiring my coaches and mentors one-on-one. A lot different than being in class with a lot of people. So if you're interested in trading, I will teach you a skill that I've been using to make my living for over 30 years, and I'll teach you everything I know, and I'll do the best job I can. And I can't think of a time where I've had students say, I wish I wouldn't have taken this class. They all say, Greg, I'm really glad I took this course. So if you're interested, please reach out to me. My email is in the link of this YouTube video. Just send me a message and we can get the process started. But I'd love to have you as a student. I'll teach you everything I know, and I'll give it 110%. If you like online courses, I have a really good online course available at udemy.com. I've sold so many of those around the world, and that course is called the Deep Dip Buy Stock Trading Strategy. It's 9.5 hours of video, and it's just one trading strategy, the Deep Dip Buy Trading Strategy, but it's a great course, and it's very affordable. It's somewhere between $30 And I believe I have like 4.85 stars on that course. Like I said, I've sold so many. So that's a good place to get started. So either the online course with udemy.com or email me and we can talk about doing the 20-hour one-on-one course. So, all right. Thanks for letting me put my plug in. And now let's get on to the potential trades for next week. All right. Here's Adobe. Actually, one of my students highlighted this to me. It didn't trigger, but it could trigger next week and it looks really good. So here's Adobe is ADBE. Currently, the RSI on Adobe is 29.19. So if on Monday we closed above 30 RSI, that would be a rejection of the 30 RSI. Close under, close over 30 RSI. That by itself is a deep dip buy. That is legitimate. But really what I'm looking for, as you know, I like to look for confluences. And the confluence that I'm looking for is this trend line, this megaphone trend line. A megaphone trend line is when you have a swing low and then you have a lower swing low and you connect those swing lows and then that trend line goes out into space. A lot of times that third touch of the trend line, here's one, here's two, and now we are at three, but we're under this trend line. So Monday, for example, if we close back above that trend line, that would be a rejection of a megaphone trend line. Okay, that's a legitimate entry by itself. But at the same time, if we do close above that if we close above that megaphone trend line, we will by default close above the 30 RSI because we're at 29.19 right now. So Monday, if we close above that trend line, for sure we would close above the 30 RSI, and that would be a nice confluence of signals. And so if that happened, where would be my end of bar stop? It'd simply be a close back below 30, just to make it simple. But again, we have the megaphone trend line. We are currently underneath it. If we get back over it, that would be a good sign by itself. And also by default, getting above that trend line would also put us above the 30 RSI, and that would be the confluence. But again, if it does trigger, I will and close above the trend line and close above the 30 RSI, I will consider getting in for sure. But my end of bar stop in the future then would be a close back under the 30 RSI. In addition to that, everybody, we have a double bottom bullish divergence. So if we look at this low here and we look at the depth of the red MACD bar, they're down pretty far, okay? But now we are lower here than we are over here. But you see how the depth of this MACD bar is red, yes, but it's not as deep as this previous low's depths. That essentially, just from a MACD perspective, means that you are running out of selling momentum. And if you're running out of sellers, the implication is you're going to go up, because that's why markets go up. They go up because you run out of sellers. It's not the buyers, it's because you run out of sellers. So we have a low here with fairly deep red MACD bars. Here we are much lower, but the MACD bars is not as deep. So that's the other way to kind of, this is another thing to overlay on the potentiality of taking this trade. Really what this just says is we're running out of selling momentum. And the implication of running out of selling momentum is you're going to go up. So we have a double bottom bullish MACD divergence. Now I just need a signal. And the signal will be a close back above the trend line. And by default, a close over the 30 RSI. And if that happens, looks like a good setup. That's why my student Vivek, thanks for pointing this out to me on Friday. That would be a good signal. But I have to wait, again, I have to wait for the market to tell me it wants to be above this trend line and it wants to be above the 30 RSI. CarMax. All right, I talk a lot about bullish order blocks, but there is such thing called a bearish order block. A bearish order block starts with a swing high, followed by a swing low, followed by a higher swing high, and then going below the swing low, changing the market structure to the downside. Swing high, swing low, higher swing high. Market structure change. Was the market structure change correct? Yeah, it certainly was. Now, we talk about smart money being in the bullish order blocks. Well, if you look back here, was smart money buying here? 100% no. 100% no was the opposite of smart money. Well, look at this. We're coming back up to the area of the non-smart money. I hate to say it. I don't like to use the word, but it was not smart money up here. And we are heading back up into that area. Now, look at this. We have a 200-day moving average that's living inside the bearish order block. So if we continue up next week and we reject the 200-day moving average, the black line, we have a key level within a key level, but the difference here than normally what I show you is we have a key bullish level within a key bullish level. Here we have a key bearish level, the 200, inside a bearish order block. So this 200-day moving average above us is resistance. That's going to be tough to get above. So if next week we come up, reject that 200-day moving average inside the bearish order block, that would be a pretty high probability short trade. And so I'm looking for a short trade. So if it rejected the 200, closed below it, I very likely would take that trade. And then my stop, of course, would be a 2 ATR emergency stop above. And then my end bar stop would simply be a close above that 200-day moving average as well. So that's what I'm looking for potential short on CarMax. Rejection of that 200-day moving average that we are below now. If we reject it, close below it, I would likely take a short position on that trade. TLT. All right. Talked a little bit about bullish abandoned babies. We had one that formed here. The box, the blue box is the baby because we gap down, gap up. Okay. So that's bullish. Now, has it been bullish so far? Not really. But I do know that when we have a bullish baby with a gap down and a gap up, I know the key level is the high of that baby. The high of that baby is 86.11. And you can see 4 days ago, we did get to that level and close back above it and then bounce. So that's a key level, 86.11. Now, I didn't take this trade, but in the future now, if we come back down and reject that 86.11, or in other words, we go below it and we close above it, I may get long there. And the way that I would express that is I would do the 2 ATR stop below, 4 ATR profit target above. Okay, so if we reject 86.11 and I decide to take the trade, 2 ATR stop for a 1% loss in my account, 4 ATR profit target for a 2% gain in my account. Now, if next week we go lower and don't reject the 86.11, but we reject the high of the order block or we reject the low of the order block, I could also take the trade there. And if that happened, I would just do the regular where I take partial profits, go into trailing stop mode, all that kind of stuff. So just want to be clear on the difference. So if we reject the 86.11, then I'll put a 2 ATR stop, 4 ATR profit target. One of those two is eventually going to hit. If we close below it and reject the high of the order block or the low of the order block, then I'll trade it the regular way. But we have changed market structure. I'll just show you right here. Swing low, swing high, lower swing low, market structure change. So technically, this entire bullish baby is also an order block. See that? Swing low, swing high, lower swing low, market structure change. This becomes the order block. But because I see the baby here, that's why I'm keying off of the 86.11 level. So if TLT comes back down next week in one way or another, very likely I will get long. UNG, which is natural gas. All right. So I've talked about abandoned babies, but there's also such thing called a island reversal. An island reversal is very similar to an abandoned baby. It's just that abandoned baby consists of one bar, and island reversal consists of 2 or more bars. So the island reversal was formed here. You can see we gap down on the 13th. We gap down. We have a few days sideways, and then this bar gaps up, leaving this entire group of like an island. That's why they call it island reversal. Now, just like abandoned babies, the high of the abandoned baby is the key support level. The high of the island reversal is also a key support level. So the high of this abandoned baby is this bar here, 1057. So look at this. We are getting very close to the high of that island reversal at 1057. If we reject the 1057 level, the way that I would express the trade is the same as I just mentioned on bonds. 2 ATR stop, 4 ATR profit target, one of those set it and forget it trades. And in my experience, more times than not, I'm going to hit the 4 ATR profit target more than the 2 ATR stop. But it's not for sure. It's just more times than not. So that's what I'm looking for on UNG. You can see it's extremely low and looking for rejection at 1057. Verizon. So Verizon had this huge move up for multiple reasons. But one of the reasons why this was a safety play with what was going on politically, well, now that the market has regained some of its footing and there's less fear in the market, sellers have come into the safety play, and that's why Verizon has come down. However, we are getting to kind of a key level here at the moment. So I am looking for a rejection of 45.80 inside of this order block. And here we have an order block, but here on the 9th, we had this big up bar. Whenever you have a big up bar, from a Fibonacci standpoint, halfway of that big up bar, there should be some inherent Fibonacci support. Now, I like to buy rejections of major moving averages or under 30, over 30 RSIs inside order blocks. But in this case, there are no moving averages for me to key off of. So sometimes I have to make my own. And that's why I put this bar in here at 45.80, because it's halfway of this big up bar that resides inside the order block. So this is my key level, 45.80. Next week, if we reject 45.80, I will definitely consider the trade because one, it's in an order block, and two, I know that halfway at this big up bar here on the 9th should have, not for sure, but should have some kind of support. So next week, if we reject 45.80, I'll consider taking the trade. I'll place my 2 ATR stop below, and my end of bar stop, if we reject 45.80, will just be a close back under 45.80. And then last but not least is Exxon. So Exxon, of course, had this huge move up on all the political things going on in the Middle East, and now we've had a big sell-off. But we are coming back down to kind of a key level again. Here's an order block. Why is it an order block? Here's a swing low. Here's a swing high. Here is a lower swing low. Here we change market structure to the upside by taking out that swing high. We also define the order block. Lowest closing bar before market structure change. I bring this into the future. Again, when you look up here at the high, and you look back to the order block, was smart money buying here when it eventually went here? For sure. Well, we're getting back to the smart money area again. Again, with this example, there are no major moving averages inside this order block, unfortunately. So I make my own. Here we go. On the 11th of March, we have a big up bar. Where on that big up bar should we have, would be kind of a key support level? Halfway, the 1490. So I highlight this level, bring it into the future. Now I have a key level within a key level, 149.40 inside of the order block, key level within key level. So next week on Exxon, I am looking for a rejection of 149.40. If it rejects it and I take the trade, then my end of bar stop will be a close back below 149.40. So, well, I hope that was helpful, everyone. If it was, I really would appreciate if you could hit the thumbs up button or subscribe. It really helps out the channel. If you have any questions about anything that I discussed today, please put them in the comment section. I'll do my best to get back to you as soon as I can. I hope you have a really good rest of your weekend. I have baseball practice here in about an hour, so I'm looking forward to that. If I can help you with anything, please reach out, contact me, whether it's my 20-hour one-on-one course. I also do private consulting. I can help you with a bunch of different things with trading. So just reach out to me, send me an email, and I will definitely reply. So I always like to leave off everybody with, please try to go out and do something nice for another human being each day if you have the opportunity. This world certainly needs it, and we like it when someone does a nice act of kindness for us. So why not just go out and do something for someone else? I'm also a very big animal lover. If you have the opportunity or any chance you come across where you can do an act of kindness for an animal, they certainly will appreciate it. It's just good karma and good all that kind of stuff. So I always like to leave off with that. But thanks again, everybody, for watching the podcast again. I hope you found it helpful. I hope you have a good rest of your week. And be careful out there. Follow your plan. In the long run, really, it's the only way to do it. And God willing, I will see you next week. So thanks again, everyone. Thank you very much. And we'll talk to you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.